It's time now for business news with Madison Reedy. Hi, Maddie. Sky City. So they're going into online gambling. What's the plan here? Because they can't actually do it in New Zealand, can they?
No, they cannot do it here. So they're doing it out of Malta. So they've teamed up with a Scandinavian company, and they're going to create this online gambling website. It's going to be based out of Malta. It's obviously, because it's overseas, going to have the URL ending in .com rather than .co.nz. Now, they obviously can't do it here. Online gambling is illegal in New Zealand, bar the TAB and Lotto. We did know that Sky City was keen on doing this. They've said that they want to get into the online gambling space for a while, but obviously they've been trying to figure out how and obviously where they can and can't do that. And the reason that they wanted to get into the online gambling space is because they're actually losing money to overseas-based online gambling websites anyway. They reckon that they're losing about $160 million a year to these overseas-based websites. So it's created a bit of a hole in its earnings. They hope that this new plan will plug a bit of that gap. But they don't actually expect to make much money from it. This isn't necessarily a big money-making scheme. It's more of a learning and education path for them. They obviously want to see it regulated here. They said that they're happy to work with the government on that, but this is basically them dipping their toes in the online space to figure out how to do it and how to do it well. They will pay goods and services tax on the earnings from this. Overseas-based online gambling websites don't pay that tax in New Zealand, and they said they're also going to comply with the host responsibility rules that apply to casino operators in New Zealand.
That's interesting, isn't it? Okay, the Reserve Bank has reviewed the LVR restrictions, but they're not doing anything with them?
They're going to keep them. So the loan-to-value ratios essentially restrict banks from borrowing too much to essentially first home buyers, typically who have small deposits. So that's typically deposits below 20%. Now, basically, it means that they'll face less risk if the economy ever sours. Now, these were introduced by the Reserve Bank back in 2013, seems like forever ago now. And at the moment, banks can only lend 15% of their loan book to owner-occupiers with those small deposits, and about 5% to property investors as well. Now, these were eased in 2017 by the Reserve Bank, so they have softened these around the edges a bit. They have been tweaking with these while they've had them in play. But they've obviously been in place for 5 years now, so the Reserve Bank thought, hey, it's been about half a decade, let's have a look at them and see how they're going, and, well, ultimately, if we should keep them. They found out that while they have faced a couple of hurdles and some unintended consequences on the way, including actually unintentionally restricting first home buyers from the market when they first began, they've decided that they have been working pretty well and as intended, so they've decided they're going to keep this tool in their toolkit for a little bit longer. Some of the hurdles that they are also mentioned there was that when they focused particularly on Auckland in 2015, they slightly tweaked it there to restrict Auckland particularly. They saw that actually spilled house price growth into other regions of the country.
Because people went shopping elsewhere.
Of course they did, because it was cheaper to do so. But they do say that the LVR policy has been successful in working to alleviate excessive house price inflation and also excessive household credit growth as well. So ultimately they're keeping it, and they've made that decision because they don't want to have to use for a very big, complex term, macro-prudential tools. This will disappoint some, though, because obviously when they introduced this in 2013, it was temporary. Now that obviously has a big question mark over it, whether it is temporary or not, whether they will scrap it in the future or just keep it and keep easing it and tweaking with it. In fact, Century 21, the real estate firm, yesterday actually came out and said that they want to see a review of LVRs, which the Reserve Bank has done, but they ultimately wanted them scrapped. And they say that's because some first-home buyers, particularly in Auckland, are being further pushed away from the property ladder.
Because they can't get the deposits together,
because of
large deposits.
Exactly, because when you have a house in New Zealand that's an average of $1 million, that 20% deposit is about $200,000. So they're saying that's just unfeasible for many young people in New Zealand. Now, obviously, the Reserve Bank has made this decision to keep LVRs with the backdrop of their capital review. We obviously keep talking about this. I keep bringing it up. The Reserve Bank wants banks to hold significantly more capital. That, along with LVRs, are just one of the tools in their toolkit to try and keep the banking system and the economy ultimately in check.
Hey, what else has been going on today? Marcus, should we do a quick whip around?
Yeah, let's do a whip around. The NZX Top 50 Index closed up 0.2%. That's a rise of 21 points to close at 10,237 tonight. The New Zealand dollar, that's buying at just under 65 US cents, just hanging on there. 94.5 to the Australian and about 51.1 British pence.
Thanks, Maddie. Madison Reedy there with business news.